Right, so we're changing over the slides first. All right, so I think we have majority of the audience back in the room. So we're starting our time very shortly. So have a round of applause to invite Mr. Paul Chew and his research team to be sharing on the Singapore market.
Thanks everyone. So my fellow Singaporeans, that's kidding. Next break for the next 4 years. Okay, anyway, for today, good afternoon everyone. So thanks so much for joining us here today. I'm with my fellow analyst team. So we're just going to give you some macro views and so far how we see the third quarter. So in part, the picture there is partly because Superman is coming on the 11th of July, but anyway, it's also because we see Singapore as a safe return haven. Okay, this is not an up and away, but at least a safe return haven. And also, there are a few characteristics that Singapore has. I mean, even though the US has climbed up year to date in US dollar terms, Singapore is still the better performer. The biggest worry we still have is the trade war is still in the background, and it's hard to price a trade war. It's very binary. And even in the worst case scenario, Singapore is kind of shielded because we are at max, we already hit 10% since we have a kind of trade surplus with the US. And that's what we mean by this particular picture. Because for us, our base case is that there is still a trade war going on. And like we mentioned, you saw in the news, even Donald Trump is kind of rekindling it with Canada. So that's why it is now all green light and ready to go. That's why. As usual, we have a disclaimer here. Again, this is all our personal views. We may change it, especially with Donald Trump changing his mind, so we also might change. But not as bad as him, but we still have we might change our views because things are quite volatile these days. And we take from public information and do seek advice from your financial advisor. Okay, so this is the agenda. We will start off with what happened in second quarter. History lesson, nobody wants to know so much, but we'll still have to go through that. We'll give you a very quick macro outlook. Zain, my colleague, will talk about technicals, his top picks of large cap, small cap, and so forth. And then we usually have a sector specific for banking and REITs, because these are the two core sectors. I mean, like index probably 60-70% at least is all REIT, bank and REITs. And then we will have one, we try to change it, so we will have a very broad sweep of all the various stocks and so forth, and we will close it with our model portfolio. We usually do it after the month end, so that's why we didn't do any changes, because the rule is to do it when the quarter ends, but it's the same as the prior quarter. So we will only change it when we come up with our quarterly. Okay, so we'll start off with the quarter results. So these are the large cap returns for some of the key ones. On your right we usually have the banks. So the banks did pull down the index. The banks, in part, there was a bit of a dividend impact, right? Because once you pay off the dividends, it goes X, and there's a bit of a price. Because this one is not total return, it's just price return. And the whole problem with asset concerns because of the tariffs, so the banks did a lot of provisioning, which I think my colleague will touch on. A lot of metro stuffing, like maybe your great-grandparents kind of situation. And the one on your left, selling assets pay off. So these are the best performing stocks, large cap. Hong Kong Land did very well. So why they did well is because they sell assets. So selling furniture actually does well. It's because they give a commitment to sell at least 4 to 6 billion of assets by 2027. We hope, we can only hope that CDL will do something like this, then hopefully it can also come. Those who are laughing are normally most likely the shareholders. So, but the other one that's done well is DFI. They've also sold assets. So selling assets does make sense. Of course, you cannot keep selling assets, right? But at least for now, let's be happy about really sell assets. And surprisingly, in Hong Kong, as you know, vacancy is up. There's even a possible MPL by a large property developer. Even then, you sell assets, market react. So this will be the response function if any property developers. Of course, ST Engineering, we know it's an arms race. Just have to read your newspaper, you know why everyone is stocking up in weapons. The one on your bottom right is the worst performers, Wilmar. they had to put a deposit with 900 million deposit with the Indonesian government. This is not deposit to buy things. This deposit maybe can be forfeited. Then, of course, Maple Tree Law is because too much China, your rental reversions are as low as 10%, so your rents keep shrinking. Thai Bath, I think there's no need to see. Let's look at the whole Thai market. It's down like 20%. So basically, they outperform in a way. So then the REITs are starting to recover, which my colleague, Darren, will talk about more. So the theme for second quarter is how to survive the trade war, and hopefully it's just a trade scam. But if you look at the performance of the various asset class in US dollar terms, Singapore, if you look at the blue one, SING, we cannot put STR, we've got to pay money, so we put SING. But anyway, if you look at the blue year to date, Singapore is up actually 12% because the Sing dollar appreciated against the US dollar by 7. So 7 plus around 4 the year to date. So that's why we got like 11. And if we are still outperforming the US, which is up about 4%. This is up to Thursday because I'm not so hardworking, can I get Friday? So okay, so it was up to only Thursday, but we normally do the month end. Again, gold has been the best performer, so good luck to everyone, and I will try to quicken up so you all can get your lucky draw. But gold has been the best performer, but this year about 27%. And Asia has also done pretty well, 13. APXJ means your Hong Kong, your China stock predominantly, and of course India. This is my last slide on returns. So this is just a snapshot of the performance of the Asian markets in local currency. So if you bought Korea, congrats, you did really well, partly because of the politics improving, and of course the tech sector heavy. Of course, if you bought into Thailand, then just be patient, I guess. Yeah. So I mean, year to date, Thailand is the worst performer because we know there's a bit more political strife, and for Thai Baht was a bit more because a bit of legislation, excise duties on Vietnam. Okay, anyway, I won't run through this too much. Okay, I will just give you a view on how we see the macro. So our first view is that the global economies are, I guess, predominantly US. Although it's a Singapore strategy, we talk about US because Singapore is a price taker. So we have to see how the economic cycle in the US. So we think it's slower, but there is no recession risk. So there are many indicators you can use to track recession, or you pick your poison. But we're just picking this one because it's the most volatile. And the shaded area is recession. So right now, if you want to make a recession call, there's really nothing out there. Employment numbers, I don't have it here, but employment is getting a bit tighter and so forth, but nothing to be really particularly worried. So that's why for us, our base case is that we don't see anything. Slower, definitely. There's going to be a consumption shock because of the tariffs. And also, if you do this GDP now, where that tracks the GDP almost every week, sometimes daily, whenever any data, there isn't any red flags for us to worry about. You notice on your far right, there was a bit, it dipped a bit because it's a bit technical because imports is considered negative to the GDP. But right now, there isn't any particular red flags. But the two things that is holding the US economy is really, actually, ironically, the stock market itself these days is the one that's holding up consumption. So if you look at this chart, which is the US net worth, it used to grow maybe 6-7%, but you notice in 2020 or 2021, you notice there is a huge jump during the pandemic. That's where. Okay, that's when you saw the big jump. There's a 20% jump in the net worth of a lot of US, and this is a pillar. So imagine if you look at your stock account, your wealth went up 20%. So even though things are slowing down, you'll still have the propensity to spend. So even though you notice there was a dip there, that was up to March, but I think the strong stock market, ironically, can drive the economy these days. Because global economies now, there's so much financialization of the real economy that itself is a pillar to the whole US economy. So ironically, if the stock market really collapses, it will snowball and cause issues with US consumption. So right now, again, this is one pillar. The other pillar to the whole US economy, why maybe a year ago everyone said there's going to be a recession, but it didn't happen, is of course the government spending. So government is injecting, it used to be 3.5, now they're injecting almost 6%, let's round it up to 6% of GDP into the economy. So I did calculate, Singapore government, we don't inject, we actually subtract, so it's a surplus. So if we actually spend like the US, our SG60 won't be 600, it's about 10,000 for each of us. So if you have a Trump was president now, we probably get 10,000 vouchers because you want to get this 5%, right? So that is, of course, if Singapore has a 5% deficit, we're all going to have a good time, right? 10,000. But of course, somebody has to pay the bill. And I'm just mentioning this. So if you change it into a US economy, somebody has to pay the bill. So if Singapore ever go into this splurge in spending, our currency will get hit, our interest expense, bond yields will rise. But I'm just giving you an example. Of course, we're not going to get a 10,000. Please don't quote me. I'm just saying as an example. If we spend like the US in the SG60 voucher is small. Of course, we're not getting it up. Please don't say that. Okay. There's one last one on macro. Not going to give a lot of cyclical views, like because things are so volatile. But I'm just give you a framework, just to give you where we see the sequencing, how we see the US economy sequencing. If you do take pictures, if it's right, please show it. But if the next 1 year or so it doesn't come up, please don't bring it up. But this is how we see the sequencing. Because this long-term forecasting, and it's really. But just to give you a sense of what will happen. So what we think will happen is when we get the new Fed chairman, I will have individual slides. So if we look at the Fed chairman, 15 May, obviously he's going to do one thing. He's just going to do an interest rate cut. And with Donald Trump, with the interest rate cut not enough, he's going to do QE. We did have QE 1.4, now maybe QE to infinity. Then, like I mentioned, like Singapore, if we were to do that, the currency would normally take a hit. Then once the currency hit, you stimulate so much, you probably get that inflation. Then that's where you get the bond rioting. What we mean is that even though the Federal Reserve cut rates, I know it's a bit complicated, but this could be the possible sequencing. So even though the Federal Reserve cut rates, but interest rates go up, then what do you do as a government? You cannot raise money anymore. Then you have to do a fiscal retreat. That means you don't spend so much. No more 10,000, no more 10,000 voucher. Got to give 600, maybe like this. Then you might get the bear market. Because we do get questions, with all this, do you think there's a doomsday scenario, there's going to be, so we don't think so. This could be the possible sequencing. Okay, I know macro kind of bores everyone, but anyway, let me just try to elaborate. So sometimes we meet corporates, we just tell them in 12 months' time, 100% there will be a rate cut because it's being politicized now. The new Fed chair that comes in will definitely going to cut rate because Powell, he is called, Donald Trump, as we know, has called him a loser, termination, too late Powell. Many other names, but because this is a family event, I cannot say a lot of it. But generally, he called him all kinds of names. So obviously, whoever comes in, automatically is going to cut rate. And do note that actually, to be fair to Trump, cutting rates does have a benefit. You actually can bring down the burden because the US is paying $1 trillion in interest expense. So by cutting rates, there is some merit to it. Like, at least you don't have to pay so much interest. So there is a benefit to it. But just watch for the date. But why we think REITs could run by year end is because the market's not going to wait for 15 May. Then okay, we'll start buying a bit of REIT. The market might start pricing in a rate cut because you know a new Fed chair is going to come. Of course, you will say there'll be inflation because of tariffs, but no, the new Fed will just say, oh, this is temporary and full stop. Okay. Oh, sorry. Oh, sorry, 226. Yeah, you're right. Oh, please give him the gold price now. Yeah, you're right. Yeah, so many read it didn't go through. Yeah, thanks. 226. Sorry. Okay. The gentleman in blue shirt. But don't deduct for me. Okay, so let's move on. So the other thing is the rate cuts. That's what the market is pricing. So the market still believes there's 2 rate cuts in 2025 and 2 rate cuts in 2026. Not much to add in this, but just to give you a sense of where but we still think rate cuts are coming because it's political. Then of course, this is complicated, but anyway, this is just to show that there will be QE. So rate cuts won't be enough. So QE, for those who may not know, that means the government, the Federal Reserve go and buy bonds. It's like MAS go and buy bonds, which is unheard of. But of course, they do some liquidity sweeping. But it's like MAS go there and buy bonds and kind of bring down interest rates. So this is what the Fed will do. It will help lower yields, and then together the QE cannot be rolled out, and the Treasury actually brought down their book by 1.5. So there's room to buy up to 1.5 trillion. So what we're just trying to say is he will bring rates down, he will bond yields down, whoever is the new Fed. Okay, but you got to pay the bill. No, in China, you have to my tan. You cannot keep on having such a fun time. Somebody has to pay the bill, right? So the pay the bill comes when the US dollar. So that's why we see the US dollar under pressure. What we do, why this chart here is that even though the red line is basically the difference, that means when you see the red line go up, you notice the US dollar strengthen because generally because US dollar interest rate is higher, and even if you want to do a carry trade, you of course go into US. But what we're trying to say is this pattern has changed. Even though US interest rate is high compared to the ECB, and ECB has cut, that means the European Central Bank has cut interest rate 3 times, but the US dollar still weakens even though it has a higher interest rates. Of course, they are diversifying, but this could be a precursor if they keep on doing this and people lose belief in the US bonds and might come up. But again, this is just to give you a sense of what could happen, that even though interest rates is high, doesn't mean you will support your currency. Okay, then the biggest worry where you get that transmission is that inflation starts to hurt equities, runaway inflation, then you got weak dollar, you got so much spending in the economy, then inflation will come. Then that's where you know that they cannot keeping rates low. I'm going to run through this. Then the biggest problem you're going to have is when you get a bond riot. So if you look at this chart, the blue line, like we mentioned before, so this is the 10-year bond yield. Which go up means bad for the bond market. Okay, so it's actually the inverse. So if you're a bond manager from 1960 to 1980, you probably got sacked because there's nothing you can do because the bond prices keep going down. So the best would have been a bond manager in 1980. You just have to come to office, turn on light, you make a lot of money, like 40-year bull run. Make sure the bonds are there. Just make sure just make sure your office lights are turned on and you will make the 40-year run. So of course the bull run is over. So what we worry about is the bond riot. That means the bond prices keep on running, the Fed cut rates keep on running. Something like what we got when the European the European crisis, if you recall, in 2013. Yeah. Okay, just my last one on before I run to Singapore. Just that the fiscal receipt. So even though the US, so this chart is the amount of government debt held by public. That means not us, maybe the central bank in China or Japan or some of the funds. So it used to be 13 trillion, now 30 trillion. In the next 10 years, they need to find 22 trillion of bonds to give to strangers. So I'm not sure why Trump is acting so harsh on foreigners, because he needs a lot of people to fund the deficit. And if you know this thing called the revenge tax, which is Section 889, lucky I remember the number. Okay, but basically what it means is that it's like if you put money into the US, and if your country, Singapore, raise taxes, then they have the right to raise tax on any investor in Singapore. So I mean, this is like if you got 20 trillion to fund and you still treat investors so poorly, this fiscal retreat could happen. I mean, then investors do not want to buy into your debt. That's why they need to find 2 trillion of new bond investors every year if you do the maths. So anyway, so this fiscal retreat that means they are forced to bring down the deficit. Otherwise, nobody wants to buy the bonds. Okay, I know this is very complicated, but let's move it on. Okay, let me go to Singapore. So we think Singapore is the safe return haven. Okay, this is very complicated, but let me just this is my last complicated one. Promise. Okay, so if you look at the blue line is actually the Singapore foreign reserves. Before the pandemic, we had about 300 billion US. You notice it spiked up, but it came down. It came down because if you read the middle note, so this is quite important. Sorry, this is the only time I'm going to ask you to read anything. 260 billion. So the MAS actually, the government took 260 billion from MAS and gave it to GIC to manage. That's why you saw the reserves come down. And of course, you all know we are going to get 5 billion. So just give us a little bit of the 260. At least now we got something can put in the Singapore market. So thank you. So out of 260, we got 5. Maybe you can give a bit more. No? Yeah. So but anyway, so what I'm saying, there's more capacity to actually give since they got 260 there. But anyway, if you add that back up, the real reserves of Singapore is almost 600 billion. There's a lot of liquidity coming into Singapore. Partly because we are AAA and of course the strong currency. So that's why a lot of investors view us as a safe haven. We call it safe return haven. The table on the right is just to show you the change in reserves. We used to get only 8 billion, then minus 8, maybe 32, but you notice the huge, in bracket means if you add back the one that was the amount of reserves that went to GIC, so you add that back, there's a lot of liquidity that went into the system, especially 2023 and 2020. Then of course we still have the strong currency. So this chart is just to show you that currency and equities move really in line. So the blue line is equities, Asian equities, and the red line is the Asian dollar index. Basically Asian currency. When Asian currency go up, the equities tend to follow. So that's why if you look on the table on the right, this is also your holiday destination. Anything below Sing dollar means Sing dollar appreciated. So this is against the US dollar. Anyone who wants to know why Food Empire did well, so you look at the first one, is called Russian ruble. So the Russian ruble went up 44%, and Russia is a food empire. Your customer just got 44% richer. So anyway, so I hope nobody asks me anymore about food empire question. The TWD is Taiwan dollar. So in case anyone wants to buy Asian Pay TV, you've got this currency lift. So that's why we also think that with the strong currency will also drive equity returns, which I think right now we're beginning to see a lot of people diversifying. The bottom negative, this is the US dollar compared to a basket of currencies. And of course, Singapore, the valuations are attractive. The problem with showing this chart is cannot show too often. Otherwise people will realize it's always been very cheap. So you got to show this like every 2-3 quarters you show, then people are really cheap. So hopefully they don't notice that it could have been the same chart last quarter. Okay, then this one is more important. Okay, this is dividend yield. So right now, because interest rates have dropped so much, you put FD maybe 2% or something or so. But now the dividend yield for Singapore equities is as much as 5. So although interest rates have come down, the valuations didn't expand. So you're getting a carry. So if you don't think of 10-year, you just think of your Singapore SSB. So SSB and 10-year is almost the same. So the SSB now could be Singapore savings bond is 2, Singapore market is paying 5. So that yield is actually getting more and more attractive. Yeah, especially for the banks. Yeah. So of course, this is Singapore. Our balance sheet is strong. I know some came out in the media said the banks shouldn't pay so much dividends, but why stop dividends? Myself don't pay, give out loans, don't do anything, shut the bank door, and just keep the deposits, right? So you can see that the Singapore household balance sheet is very strong. There's really the provisioning that they do. Of course, apart from overseas, there isn't really much of an issue for Singapore balance sheet. And one last one, pandemic. Of course, if I'm the census, if I'm planning infrastructure for Singapore, I'll be worried because our population really collapsed in 2021. But right now we're getting a population growth. The red line is the white paper. Okay, so at least the population growth actually makes businesses more. When you speak to business people who at least deal predominantly in Singapore, they are happy that the population is up because it actually will be a stronger property market, stronger retail and so forth. So I mean, just to give you a sense that the growth in population does help the Singapore economy. And this is my final one on Singapore before I hand it over to my colleague. So just to give you a sense of, not all sectors are doing well. So we're not saying Singapore is rocking and rolling, but the sectors that are doing well is banks because there's still loans growth, building materials, because construction is 50 billion, is record high. It's growing like 30-40%. Power, we'll show you a chart later, and property sales are up almost 160% this year. We are still neutral in electronics. I know you can ask us about the Franklin questions or that later. Mainly because of the trade war. But of course, if we had to pick one, our favorite would be Franklin because the valuations are attractive. Healthcare and it's not so strong. But we go through all this, but retail also not particularly strong and so forth. This just give you a sense of our grounding when we meet corporates. So this is where the sectors that are doing well and not doing well. Okay, I'll hand over to Zain, and then he will just discuss about the technical. I think you all know what that is.
Okay, thanks, Paul. So hi everyone, I'm Zain. I'm the technical analyst. So I'll be giving a technical outlook for the Singapore market in terms of the blue chip, the small caps, also our stock picks for both the large cap as well as mid caps. So our title is higher after 90 days. So if you remember at the start of our second quarter's strategy event, it felt like doomsday after the Liberation Day. However, we see that it's higher after 90 days. After Trump actually posted on his Truth Social twice, it was a great time to buy. So once it was near the bottom after the Liberation Day. Then second time it was just before the US-China they did a pause on the tariffs. So we see that it will be likely higher after 90 days as well, after this event, going to the third quarter. So if you look at the picture, I'm sure that we all know who he is, Donald Trump, sitting on a piece of taco with the markets going up in the background. So yeah, I think this is a very good summary of what happened during the quarter. So taco actually stands for Trump always chickens out. Yeah, so I guess it's a very good representation since it looks like the American version of a roti prata. So it just is a flip-flop king, and the market just goes up, like he doesn't take his threats seriously. So first I'll talk about the outlook of the Singapore market. So this is the ETF tracking the blue chips. The stock code is ES3. So if you look at the chart, this is the weekly chart. It's actually steadily trending higher inside this uptrend channel, inside this black color channel. So despite the sell-off at the start of April, it managed to recover all the way back up. So now we have seen 5 consecutive quarters of gains. As of now, second quarter is up 1.3%. So you can see it's very resilient. Trading at the upper end of this main uptrend channel over here, and it's still trading, still holding over there in this channel since November of last year. Recovering very well from the Liberation Day sell-off. So in the quarter ahead, third quarter, we do see continued upside for the blue chips. For this ETF, we see a target of about $4.15, about 2.7% upside from the current levels. Next one, I'll talk about the small caps as well. So I think don't sleep on the small caps, even though it has been a flatline patient since about 2024. But the chart actually looks very promising as of close of this week. So I think the title will be it looks like a fresh breakout of a key resistance. So if you look at the chart, it's been mostly sideways since 2024. Good thing is that if you look at the price action, start of April when there's a lot of panic, it managed to hold a 217 level as a support. And subsequently, it did a range consolidation in May and June. And as of this week, it managed to do a breakout of this 247 key resistance level. So I think this is very significant, and we'd like to see some upside for the small caps ahead. Yeah, where we could see some upside towards 277. So that's the projected target level from the range breakout. Also a previous swing high resistance level. So for small cap index, that's about 10.4% upside. So that looks quite promising. Then next one, I'll talk about the large cap pick. Our large cap pick is capital investment, where my colleague later, Darren, will talk more about it in terms of the fundamentals. So for CLI, stock code 9CI, we do see it awaiting a breakout of this consolidation. So if you look at the chart, it's been pretty much sideways, but the positive thing is that during the April panic, it managed to hold the support at $2.30 over here. Then subsequently, it did a very long sideways since May between about 250 to 263. And then I think we are likely to see a breakout of this 263, 264 level to actually head higher towards the next target around 284, which was a previous swing high start of November last year. So that will be about 7.9% upside to possibly look at for this quarter. Then last but not least, I also have the mid-cap pick. So it's WeHer Holdings. So my colleague Iban covers this stock. He'll talk more about it later as well. Yeah, so for WeHer, stock code E3B. So if you look at the chart, it's also awaiting a breakout of a consolidation. So it's very good in the sense that the stock has been trading sideways from March this year with the key resistance at the 47 cents level. Positive signs are that it's holding higher lows along the way. So it's an ascending triangle consolidation. Yeah, at the 47 cents mark. So once a breakout of these 47 cents actually occur, we do see a very huge promising upside ahead towards 61 cents. So that's about 31.1% upside as of the last close yesterday. Yeah, it is also the projected target level when you take the height of this ascending triangle. Yeah. So that's all from me from the technicals. I'll hand over time to my colleague Glenn, who will share more about the Singapore banking. Yeah.
Hey, thanks, Zane. Yeah. So I think some of you are quite familiar. I've seen some familiar faces. So I do cover the US sector as well, and I'm also covering the Singapore banking sector. So I must thank Paul for that. Give me a lot of opportunities. Anyway, yeah. So for the banking, if you look at this image here, is just showing that they are stuffing the provisions, or in other words, stuffing the mattress with a lot of, you can see a lot of money right here. So these are the three Singapore banks, DBS, OCBC, and UOB. And they're all doing the exact same thing, right? They're just stuffing more and more. And I'll go into more detail later why we mean that. Yeah, we just do a quick review first of their results. It's quite expected. Almost all the results are very similar, right? Those in the red bars are the ones that are more significant. The first one is the allowances, right? All allowances went up. And it's not that they have higher like non-performing loans or they have higher provisions. It's just that they are putting on more into their coverage, right? So I will go into a slide later on that, but just to take note that all the banks are doing that, almost exactly the same thing. And what is still very good is the dividend yield. So earnings, if you can see right below the allowances line, is quite flat, right? Nothing significant, a bit drop, and then flat. But dividend yield is still very healthy. We're looking, 6.4 to 6.9%, and that is for a Singapore bank, mainly from their capital return initiatives that they have continued to do. So they have committed to it. And in the first quarter, we saw that they have actually said, yes, we will continue despite everything that's happening. I think Paul did allude to it earlier. There was this Straits Times, I think Business Times, commentary article that was spread around quite a lot, where it says, this person was saying, this reporter was saying, why are the banks doing this? They should just be holding it back. Why are they paying out more? Isn't this supposed to be money kept aside? But what he fails to understand is that the banks already have set aside this amount of capital to pay out, right? So even after they do pay out everything, they still have sufficient capital if you look at their capital ratios and their allowance coverage. Yeah, so a few of my slides later will expand into this more to understand why the banks are doing it and why it's sort of in a way still safe for the banks to pay back and when they have enough. Yeah, so this is the standard chart that we show almost, I think almost every other quarter, where we show the net interest margins, net interest income, as well as the Singapore interest rates. So Singapore interest rates here is in the blue line. You can see that it has continuously continues to fall. But the red line, which is the net interest margins for the banks, are still quite stable. And if you see the blue chart, the blue bars here, they're also, relatively similar. So you'll be asking, how are the banks able to do this? You think that interest rates are linked very closely to their net interest margins and to their net interest income. But there are certain ways that the banks are able to do it. Firstly, by managing their funding costs. So I think there's one more slide on the bank's funding costs. But just to keep in mind for the end of 2025. So for 2025, we still do expect that it will margins will contract a bit by around 12 basis points. But that net interest income will still hold relatively stable. And this is what the banks are guiding for as well, where net interest income will be relatively similar. Yeah, so one of the ways that the banks are able to control their net interest income and their margins is from CASA. So CASA stands for current account, savings account. And these are your UOB one account, OCBC 360, and then DBS multiplier. So I'm pretty sure almost everybody here will have either one of these accounts, and you have quite a lot of money put inside, right? So what they do and how are they able to get a higher CASA ratio? CASA ratio basically means that more proportion of their deposits are placed in this current accounts. Is that maybe 1 or 2 years ago, you can get a fixed deposit as high as 4% from a local bank. But what we are seeing now, and I'm sure everyone has felt it, you can't even get it at 2%. I think the best you can get, which I've seen so far, is like 1.98% if you're on a promotional rate for maybe 3 months, right? So you'll be thinking, that's so low. Maybe I'll wait and see. So what you do with that money is that you put it back into your current account. You say, okay, I'll park it there first, and then I'll wait and see. So that's how the banks have this are able to get a higher CASA ratio, right? That's one of the ways they do it. And what it means for them is that their funding cost is lower. So for a local banks, their CASA cost of funds is as low as maybe a few basis points. And that's coming from, not from me, but from the words of one of the bank CEOs, right? Where they say, it's so low for us. So it just means that their funding cost is now lower. So that's how they're able to maintain their margins, even though loan yields have started to decline. So that's one of the way. And it will help to believe that this will continue to increase because we don't see fixed deposit rates increasing or even the SSBs increasing. So this will continue, and then more and more funds will get put back into CASA, and then the banks will be able to lower their cost of funds. Yeah, another way that they can do by lowering cost of funds is to cut rates, to cut their interest rates. They have done it already by cutting fixed deposit rates, and they're also doing it by cutting your CASA rates. So it's really quite low, and now they're cutting even more. I think if you have read the news, I think OCBC just announced they're going to cut for a second time this year, right? UOB did quite a drastic cut to their one account. DBS is really the only one that hasn't cut their multiplier account. But that is because it started with a very, very low base. Right? But I mean, knowing DBS, if you are a Singaporean, you will just put something in there for safety. Right? So that's how we believe that they will continue to lower their funding costs. And we are seeing, you see the top line here, that's the asset yield that they're getting. And they are trying to, as best as they can, control the asset yield by also lowering what they have in control. But they can't control the asset yield, but they can control their liabilities rate, which is their cost of funds. So moving ahead in the next few quarters, we will see asset yield continue to decline, but then we will also see liabilities rate also further decline in line with the asset yield. That's why we can safely say that NIMs will remain around the similar levels that we are looking at right now, and that's how they will support their net interest incomes. Yeah, so loans growth has been pretty healthy. Year to date for April, figures was around 4.9%, so almost exactly at mid-single digit, right? The banks are all guiding, sorry, not all the banks, sorry, the two banks that gave guidance are guiding for, so DBS and OCBC gave guidance, UOB suspended guidance. They both guided for mid-single digit, but they do say that, there are some risks to it. And the risk being that the uncertainty around whatever in the US might restrict some loans growth. So rate cuts at the later part of the year should improve the loans growth, but then again, this trade war is not going to help things. So we could see some pullback or some consumer demand slow down from the trade war, even though rates will hopefully get more attractive. So the banks are still guiding for around mid-single digit. We are seeing the consumer loans actually picking up. Business loans is still okay, but consumer loans will be coming mainly from the housing loans. That's what is actually pulling up the consumer loans. And I think we believe that moving ahead in the rest of the year, we could see the housing loans and consumer loans actually be the one that pull up the total loans growth. Yeah, so back to the point on allowances, right? Why we believe that the banks have enough provisions to cover, even though they are paying out so much, right? So the fact that the banks, take note that the banks during COVID, right? If you look at this huge spike up in 2020, this bar here that shows the provisions, the net amount. This huge increase was when they started to put on coverage for COVID, where they expected that, oh no, this is a pandemic, lockdown and everything. We are going to have a bunch of bad debt, about a lot of bad loans that we need to provision for. And then every bank, I think DBS is the only bank that mentioned how much they have, around 2 billion. And they say that, okay, this 2 billion will cover me, hopefully, whatever I have, and they assume. But in the end, it didn't really play out that way. So we didn't see as much bad debt where they have to provision for. So they still have this, they call it management overlay, around 2 billion. We assume that the other banks have a similar amount, and they're still having it, they are still holding it all the way from COVID time till now. So for almost 5 years, they have that set aside. And what they're doing now is they're adding more to it. So DBS has added, I think, about 300 million. So it went from 2.2 billion to about 2.5 billion, right? And that is set aside already. So even though the banks are paying out of their capital, excess capital, they have firstly this set of management overlay to cover if anything happens. And also, even after they pay out, their capital ratios are still excess. They're still above their optimal. Optimal for the banks is around 14%. So even after they pay, it's still around 14+%. That's why we believe that they have ample opportunity, they have ample capacity, to pay out this and still be sufficiently covered. Yeah, okay, the last one, I think it's the last one here for me, is the volatility does benefit the trading volume. So we have seen volatility increase quite a lot, really from Trump, whatever he's doing. So, SGX should thank Trump for that, right? We have seen the trading volumes for SGX rise significantly. And I think they believe that next half, whatever the earnings that are coming out in August will be very good because of the trading volumes. And this will not just benefit SGX, but it will also benefit the bank's trading segment. But of course, in a smaller scale, because that is not their main business, right? Their main business is still the net interest income and fee income. Yeah, so our pick for the banks would be DBS. And why we say that is because all things equal, we are forecasting for this year, for 2025, right? The banks will all have very flat earnings, right? There will be no earnings growth. They already warned us and said that, okay, if we have excess profits, we're going to be putting it into our management overlay or allowances, even though we don't need it, just in case, right? So it's quite easy for us to predict that, okay, earnings will be flat. Then what will make the one that we chose stand out? And DBS stands out because it's really the only Singapore bank that has a fixed dividend per share or fixed dividend policy per se. Yeah, you look at OCBC is fully floating, 50% dividend payout ratio with 10% capital return payout. So if earnings drop, then your dividend also drops, right? For UOB, it's a bit of a mix. So it's 50% base dividend payout ratio, and then they give you 50 cents per share for their capital returns. So it's still, if your earnings drop, your dividend will drop. But DBS is saying, no, we will pay you this $3.05 for this year. We have committed to it, even if it goes above my dividend payout ratio, right? They can go up to 70, 80%. They will still do it. And they say that we have enough capacity to do so. And we look at all the banks, financials, and yeah, even if they pay out 70, 80%, they will still be accruing capital. It's not like they're going to be losing money, right? So the banks, that's why we like DBS, because then you are more, it's a more fixed where you can say, okay, if I buy in now, this is the amount that I'll be getting. And it will be carried forward until 2026 as well for DBS. So that's the reason why we like DBS. It's not that we don't like OCBC and UOB. We also have an accumulate call for the two of them. Just some brief comments on the financial counters that we cover. OCBC, why we like them is because they do have the highest CET1 ratio, right, and excess capital. So amongst all three banks, I think they're the only ones that haven't really spent any money. The other two, they did all their Citibank acquisitions, but then OCBC is just sitting there and say, okay, we'll buy a small Indonesian bank, right? So they have a lot more capital to give back. But whether or not they give back, that's anyone's guess. We can hope that there's a possibility that they could, and we have made our calculation and said, yeah, they could actually continue to pay their special dividend for additional 2 more years in order to reach that optimal CET1 level of 14%. So that's why we like OCBC. For UOB, sorry, this one is wrong. Just ignore that sentence there. So for UOB, we like it because they are expanding greatly into the ASEAN region, where they have made a lot of acquisitions. It has accelerated their growth by around 3 to 5 years into ASEAN and into their fee income business. Right? So that's why we like UOB, where they are able to continue growing into fee income, which is what they are not traditionally known for, and as well into ASEAN. Now, if we look into Malaysia, you actually realize that UOB is one of the main credit card holders. Yeah, sorry, just ignore this sentence here. Yeah, I think it's a bit of a typo. And lastly, for SGX, the heightened volatility, like I said earlier, from Trump will boost the volumes for SGX. And also, Singapore standing as a flight to safety will also increase the volumes. So it's very volume driven and volatility driven. So the more Trump speaks, then the more trading volumes will increase, and it will benefit SGX. So that's what we believe for SGX. Yeah, so I think that's all I have. I'll now hand it over to Darren for the REITs. Thank you.
Yeah, thanks, Glenn. So I'm Darren. I cover the REITs and property sector. Yeah, so basically our title for REITs now this time around is underappreciated and due for a rebound ? So yeah, we've seen the REIT share prices really not perform too great over the past couple of months, this year especially. So and then last year also. So we are hoping for a rebound, and I'll explain why we think it might be coming soon. So yeah, just guys, just thinking when the rebound will be. Yeah, so first of all, for this picture, this is a forward dividend yield and DPU growth chart. So look at the line chart. So that is basically the forward dividend yield of the REITs. So we see it creeping up slightly, and now it's trading above the 10-year historical average. So now it's around about 6.4%. So we think it will continue going up mainly because of the fact that interest rates are likely to be cut, and the REITs will start benefiting from more interest rate savings. So as we've seen over the past few quarters, about half of the S-REITs have already benefited from lower interest rates. So if you look at the shaded region in the chart, so that just shows the year-on-year DPU growth. So what we see over the past 2 years, like 2023 and 2020 to 2025, we see shaded red, and that's the right-hand side chart, which shows a negative DPU growth. So that's, as you all know, mainly because of the higher interest rates. Interest rates kept coming up. So as a result, most REITs, they couldn't really generate a positive year-on-year DPU growth. So as a result, it's negative. But going forward, because of the low interest rates, we think this year we have already forecasted an average of about 1% DPU growth this year. So next year, we're expecting more REITs to start benefiting from this low interest rates and more DPU growth as well. So that is for this forward dividend and DPU growth chart. So next we have this price to NAV chart. So this chart, it shows the price to NAV of the listed REITs, or rather the S-REITs index. So now you see it's trading at about 0.84 times. So it's been trading about 0.84 times, like a few times it hit the lows before it rebounded. So this is one of the reasons why we think there might be a rebound, because we see historically in the past, like even during the COVID-19 and the 2016 period where it dipped to below 0.9 times. Usually after it was around this area, there tends to be a rebound in the share prices. But over the past 2 years, when it hit the 0.8 region around there, the rebound was not as much as the periods before, but that's mainly because of high interest rates. So then again, I have to reiterate how important lower interest rates are. So first of all, with lower interest rates, definitely the REITs will benefit from lower interest expenses. So that's one. Next is the fact that when interest rates start to decline, cap rates will likely compress as well. So that means the property valuations of all the assets will likely increase. So we've already seen that happening, like for Singapore, not so much cap rate compression, but there's a lot of demand from strong operating performance. So you saw asset value increase. For overseas assets like Europe or Stoneware, for instance, you see some property valuations uplift. That's mainly from cap rate compression. So that's another reason why this is a thing to look out for price to NAV. So recently, if you followed the market, you notice that since over the past 2 years, a lot of REITs are trading at below price to NAV, of like below book, basically at a discount to book. You've seen some of the REITs managers or sponsors decide to take the REITs private. So for instance, Paragon REIT, the most recent one in June, earlier this month, it got taken privatized. So it got delisted on 6 June. So if you look at the past 1 year share price performance of Paragon REIT before it got delisted, it was trading about 0.93 times the 12-month VWAP. So the sponsors saw an opportunity and they took it private at about 1.07 times. So similarly, for Fraser's Hospitality Trust, the 12-month VWAP in the past year was about 0.7 times. So the sponsor is deciding, or rather is offering to take it private at 0.71 cents, or rather 71 cents. And that represents about 1.11 times price to book. So they are taking this opportunity to kind of privatize the assets based on the fact that they see that the REITs are trading, that they are listed and yet they are trading at such a steep discount. So it doesn't really make sense to keep it being listed. So another one that might be on the cards is the Equified Hospitality Trust. So right now it's trading about 0.4 times, and there is a strategic review upcoming, or rather they are undergoing strategic review. So yeah, there might be something going on. There might be an offer coming up soon. Yeah, so the other reason why we see the fact that the lower interest rates are important is mainly because with lower interest rates, also the dividend yield spread will likely to increase from the pure fact that the MAS 10-year yield will keep decreasing from lower interest rates as well. So what this dividend yield spread chart shows, it shows the forward dividend yield of the REITs minus the 10-year MAS Singapore government bond yield. So as the bond yield decreases and as the DPU increases for a lot of the REITs, you start seeing this tick up more and more. So we see over the past couple of years, it's been increasing steadily. And right now it just hit above the 10-year mean. So I think this will likely to start increasing as both the absolute number of DPU increases as well as the fact that the yield on the risk-free bond or fixed deposit rate, if you want to use it as a proxy, you also can do that. So like Glenn mentioned earlier, fixed deposit rates are dropping and now at 1.9 something, he said 1.9+%, that's the best you can get. So as that continues to decrease, we expect this to widen further and making yield instruments more attractive and REITs especially. Yeah, so next we move on to some of our stock picks. So first of all, it's a Stoneweg Europe Stapled Trust. So this is used to be known as Cromwell European REIT, used to be known as Stoneweg Stoneweg European REIT. So now it's Stoneweg Europe Stapled Trust after they stapled the business trust to the REIT. So basically for that, not much difference. Just that now they have a new sponsor, Stoneweg, which is very strong in data centers. So we first of all we look at the occupancy chart that I've put here. It seems that in the most recent quarter there was a dip in office, but that's mainly because of some near-term release, new leases that are going to be signed, and there's some new arrangements. But this slight dip in occupancy is going to be very short-term, and it's very likely going to be to pick back up over the next few quarters, and the rent reversion over the next few quarters also will be very high, since that they release some of the new tenants that are already paying higher rents. So that is not in the numbers yet, and the occupancy has not showed the fact that the new leases have been signed already. So another positive news was that just early this week or last week, they've announced that Stoneweg Europe Stapled Trust has invested 50 million euro into a data center fund comprising of 4 very early stage data center developments. So for that, there's no really impact to DPU. In fact, zero impact to DPU, but the upside there is very high, especially since that when the data centers get fully developed, the value of that 50 million will likely be returned multifold, like 2 times, 3 times over the next few years. So there is a lot of potential for NAV appreciation there for Stoneweg Europe Stapled Trust. And the next factor also is because of the fact that the interest rates have come down. Like ECB, they cut rates multiple times. So that will help to benefit the portfolio valuations of Stoneweg European REIT. Like I mentioned, the cap rate compression. So this time around, over the past few valuation cycles, we saw the logistics asset only had some valuation uplift, for the office assets still saw some slight negative, but overall the portfolio was up. But this upcoming valuations in June, we expect both logistics and office to be up, especially since that for the office sector, they did manage to sign some very good leases and much higher rents. And also the fact that the euro has strengthened, that will also benefit. Basically, if you invested in Stoneweg earlier this year, you have benefited from the pure fact that the euro has strengthened. And yeah, so that is basically our yield. And lastly is the fact that they are trading at 8.7% yield. So we think that is very attractive for a REIT. Next we have First REIT. I know a lot of you might not be so happy with this call, because back then when First REIT was trading at $1, a lot of shareholders, when you were holding them, were impacted by the pure fact that they did some reorganization and the share price fell to like 20 over cents. So a lot of you might not be happy, but from investing in this share from now onwards, we think it's a good point. So first of all, it's definitely because of the high yield, 9.2%, and the fact that the portfolio has a 4.5% base rent escalation for the whole Indonesian assets. So as a result, that sets a stable base. And although it might be affected by some weak rupiah and such, but this 4.5% base will really set the base for this 9.2% yield. And also the fact that there is potential for a lot of divestment gains, especially since that Siloam, they've already intended, or rather they had a LOI, a letter of intent, to acquire all of First REIT's Indonesian hospitals. So they've even secured a $1.1 billion loan also to finance this acquisition. So as a result, likely if a deal goes through, so First REIT, basically they are now undergoing a strategic review to evaluate all these options. So if a deal does go through, we are likely going to see some very good positive divestment gains, and there might be management might return some of these gains to shareholders. So that is another upside in the near term. So that's why we like First REIT. Yeah. So next we have Capital and Escort Trust. So, yeah, our title is Holistic Growth. So if you joined me earlier this morning, you have listened or heard what Serena, the CEO of Class, had to mention. She said. So basically, we like them also because mainly of the fact that their portfolio is very balanced, very diversified. They have a balanced mix of stable income, which is like she mentioned, from the student accommodation and the master leases that she has in the portfolio, as well as the growth income sources from the hotel segment and your management contracts. Yeah, so in the first quarter, 70% of the portfolio, the revenue came from stable sources and 30% came from the high growth sources like your hotel segment. Yeah, and also we've seen the RevPAR recovery since COVID. You see from 2020, usually recovered all the way, and now we are expecting a low single-digit RevPAR growth going forward. And they also have a very strong asset recycling track record. So there were some examples where they managed to divest, like the Singapore, I can't remember off the top of my head, but basically they managed to divest at a very high yield and reinvest in a lower cap rate. So they had some very high gains there. And right now they still have about 300 million of undistributed previous divestment gains that they have yet to distribute, and they will just they can use that freely to top up the DPU as and when there are some shortfalls, like when there are, for instance, the AEI, when some of the portfolio goes through AEI, then they can just use to top up the fact that when the asset goes through AEI, then there will be some downtime from that asset. Then they can use this undistributed divestment gains to top up that amount, that so-called the shortfall from the income loss. Next we move to some of our stock picks and our sector updates. So that includes the rest of the team as well. So first one, I'll move on to Takraw Corp. So this was a recent initiation. So Takraw, as you all may or may not know, is a small cap stock. So it has really many different revenue segments or business segments. So I'll just run through what they do. So first of all, in their investment business, they have Gem Life, which is MHE, which is managed health estate in over 50s living. They also have a Japan real estate, some commercial assets and a hotel as well, and India real estate with healthcare. So they recently made a 6.5 million investment in this India real estate. So there's a lot of development potential there. And for the lifestyle business, they have beauty and fragrance, which is covers their shops or retail in China. So they mainly cover a lot of the perfume brands like under L'Oreal, the L'Oreal brand. They also distribute DJI drones. So for DJI, they are one of the top few drone producers or drone makers in the world. They have like 70% market share. So for Takraw, they are the exclusive distributor for that in South Asia. And they also have an Nespresso business in India that they just started. So there are a lot of growth drivers. So all these are basically all in the starting phase, and they're all trying to scale all of these business up, especially the beauty and fragrance, the drones business, as well as the Nespresso, which is we just started out only, and Gem Life definitely. So if you all know, most recently Gem Life, they applied to IPO. So the IPO will likely complete within the next couple of months or weeks. So currently, Takraw owns about 31.7% of Gem Life. So with this IPO, their stake will be reduced to 16.8%. So the IPO valuation of Gem Life is about 1.58 billion Australian dollars. So if you take a 16.8% stake that Takraw owns, it will translate to about 220 million Singapore dollars, the value of their Gem Life stake. And the fact that Takraw is now trading at a market cap of about 175 million, which is really even lower than the stake that they own. So there is some value there, but of course, they slap some conglomerate discount to that, 220 million, because they operate in so many business segments. So how Gem Life operates, it's basically the fact that they have an in-house construction team. So when they sell the homes, they get some development profit, and as well as the fact that it's based on leased land. So there are some recurring side fees from the lease of the land, which is about 19.4 million annual recurring revenue for the current 1,862 homes. So as they continue to scale up and there are more and more occupied homes, this recurring side fees will keep increasing, and it will likely over time, as it hits 6,500 homes by 2033, the annual recurring side fees will likely be well above 100 million Australian dollars, because there's also an inflation linked component, so it will likely be over that. So basically, Gem Life is performing very well, and they'll continue to benefit from this with their 16.8% stake, which is really valued more than the market cap of Takraw currently trading at. So Takraw's yield is also relatively attractive at 3.5%, even though the fact that the share price has really run quite a bit. from last year to date. Next, I'll just talk a little bit about property. So for property, there is a spike in new home sales. Like for last year, the whole of last year, there were about 6,500 new home sales, excluding ECs. This year, year to date, until May 2025, there's really 4,500. So there really is a spike, and there's also more new launches as well. This is why you see there's a really pick up there in the chart. And yeah, there is still a lot of strong demand, especially from Singaporeans and PRs. Foreign demand is still basically absent because of the 60% ABS. Yeah, so for some of our recommendations, first of all, we have CDL. So for CDL, first of all, they're trading at a 70% discount to RNAV. So they're trying to narrow this discount, and to do that, they're trying to do some asset monetization. So there is strategy is already underway when they recently divested the South Beach asset. So that's almost about 1 billion. So if you recall a few years, last year, they mentioned that they are trying to hit their 1 billion target every year, or rather that's their divestment target. So yeah, with this almost close to 1 billion divestment, they are close to hitting that target already. And the fact that CDL recently, they have some strong take-up rates for many of their property launches, like for instance, the Ori, you see over 90% taken up, and a lot of the previous launches as well are performing very well for sales-wise. So there is still demand, a very strong demand in Singapore property segment. Yeah, so that's one of the big CDL. Next we have CLI. So for CLI, it's not really a property counter. It's more of a fund manager, but it's still tagged as a property company. So for that, CLI, we like them because of the fact that they keep growing, and their recurring fee income stream is really robust. So you see the FVM, it grew from about 100 million last year to about 117 this year. And we also like them because of their asset-light strategy. They're trying to divest their balance sheet assets and trying to put them into funds so that they can continue to increase their fee income streams and benefit more from recurring fee income. Yeah, and last we have PropNext. So for PropNext, basically we like them because of the fact that the new home sales really surged. Like I mentioned, year to date it's already 4,500. The whole of last year was 6,500. So with a surge in new home sales, they'll definitely benefit from PropNext. And they're also trading at a 6% yield, and their market share is 60%. So you can't go wrong if you just invest in basically the property sales channel that has the highest market share. Yeah, so that's all for me. I'll hand over the time now to Miao. Talk about CMC. Thanks.
Hi, I'm Miao, a great airline and analyst, and I'll also cover some small caps. Yeah, so the first small cap we'll talk about is CMC Gold Mine. This is a mining company in Malaysia. Yeah, and instead of buying gold directly, we believe this is a leveraged play to bet on the rising gold price, as the new CIL facility is already in place and boosted capacity by 60%. So they increased capacity from 500 tons per day to 800 tons per day. So we expect production for gold to increase by 20% year-on-year in FY25. In the near term, we expect production to increase even further in FY26 with the introduction of the second underground mining facility. So not only ore itself, but also other byproducts such as lead, silver, and zinc is expected to increase its production with the support of the better ore grade. And so we expect production for the byproducts to increase at least by 50% year-on-year in FY25. Additionally, gold price has been on multi-year high. It increased by more than around 30% year to date. And analysts remain bullish on the gold price due to the highlighted geopolitical tension and also aggressive central bank purchases. So we expect average selling price to increase by around 26% year-on-year to 3,100 US dollar per ounce. So we do anticipate PATMI to increase by around 86% year-on-year in this financial year. And CMC has a dividend policy of paying out at least 30% of its net profit. And they tend to increase payout ratio in a year of strong financial performance. So we do believe they are able to pay out at least 40% of its net profit this year, and therefore translating to dividend yield of around 5.5%. And the next small caps we have is Zixing. This is a Chinese sweet potato operator, and they have been doing it for a long time. But what's new is that Chinese government is encouraging food securities in China by allocating land and resources. So the entire sector has been industrialized, and they are able to increase PATMI by around 40% in this financial year. And we do expect PATMI catalyst to come from this few factors. Firstly is fresh sweet potato. We expect sales for fresh sweet potato to increase by 20% year on year, as they are expanding the total cultivatable area for fresh sweet potato and also expanding capacity for its cold storage facility by 20%. And for the processed sweet potato, there's a new factory which has already finished complete construction, and capacity is expected to increase by 60%. And for the new factory, Zixing is also introducing higher margin functional products like the sweet potato powder. And margin for the functional products is at least like 20% higher than the conventional snacks. And they are also actively introducing other revenue streams like animal feed, which has been introduced from fourth quarter last year. Since Chinese government is encouraging to lower the usage of soybean in animal feed from 13% to 10% by 2030, with sweet potato as one of the key substitute. Yeah, so Zixing is ramping up their production by outsource the collection of raw material to third party, and also constructing a new warehouse for the animal feed. Yeah, so we expect net profit of around 900,000 from this segment alone in FY26. And last but not least, we anticipate the long-term growth catalyst come from the Hainan Rejuvenation Project. This is a joint development with City Construction, and that's the second largest company in China. So the total cultivatable area for Hainan is around 5 times larger than the current one in Liancheng. And we believe PATMI will at least double upon successful completion of the project. And the actual cash flow will start to kick in from FY27 onwards. And moving on, we have a stock pick for the REIT, which is Elite UK REIT. This is a UK office REIT with more than 140 properties, and over 99% of the income is generating from the UK government tenant, and they have occupancy rate of around 93%. We like Elite UK REIT mainly because of its very stable and high dividend yield of around 10%. And since there's no more break clause till 2028, so unit holder is able to enjoy the very stable and high dividend yield of 10% till then. And we do expect upside to come from its asset monetization plan. There's roughly 33 million worth of the asset to be divested in FY25. And it represents roughly 8% of the total portfolio value. Given the good track record, we believe they are able to divest at a price above its book value. And since Bank of England cut its benchmark rate by 25 basis points in April 25, we believe this will help to improve valuation as well as strengthen the transaction market. So assume all the proceeds will be used to pay down the debt, gearing will drop below 40%. And this is we have a neutral rating for the air transportation sector, essentially because of the highlighted geopolitical tension, and also the uncertainty is evolving from the trade war. Yeah, so this is a graph for the SIA load factor, which is paying passenger as a percentage of the total available seats. Yeah, even though is coming down from the 2024 peak, but it still will maintain stable compared to pre-COVID level. That's why we have a neutral rating on the air transportation sector. And for the three stocks that is under air transportation sector, we have a reduced call for SIA, mainly because we believe yield and margin is under pressure as Asian airlines has been ramping up their capacity aggressively post-COVID. So there's intense competition going on in the air transportation industry. And the recent geopolitical tension and uncertainties evolving from the US trade war impose more of the secondary impact on consumer confidence and also corporate confidence. And for sets, share price performance is likely to be volatile for sets. Yeah, so they'll be pretty much affected by all the trade war related news. Even though China and the US reached consensus to cut the bilateral tariff, uncertainty still remains in the air cargo segment, especially for the e-commerce from China to the US side. Yeah, following the cancellation of the de minimis exemption. So e-commerce from China to the US roughly contribute to around 5% of the group's total revenue. Yeah, and however, given the extensive network sets occupies, the order lost from China to the US has been made up by other demand from other routes, such as China to Middle East or China to Europe. And the last counter we have is China Aviation Oil. We have a buy recommendation for China Aviation Oil, mainly because international air traffic increased by more than 31% year to date in May 25. So we expect profit from associates, which is Shanghai Pudong International Airport, will increase by around 12% year on year in FY25. Yeah, that's all for me. I'll hand over to Ethan for construction sector.
Hi, I'm Iqbal. I cover the construction sector in Singapore. Yeah, so this is the graph of construction contracts awarded. It is split into public and private construction contracts. The red line you see here are the private construction contracts. The blue line is the public ones. Yeah, so as you can see for the past 2 years, the amount of construction contracts being awarded has been trending higher. For the most recent months, for April, we hit a total of 50 billion trailing 12 months construction contract. And this is a 46% increase year on year from the previous year. Yeah, so just for some context, BCA actually gave a guidance for 2025 construction contracts awarded to be between 47 billion and 53 billion. So the midpoint of that is 50 billion. And if you think about it, the first half of 2025 is below 50 billion. So because it has been trending higher. So I personally do believe that for the second half of 2025, it will continue to trend even higher than compared to the first half, because then this will hit the BCA's target of 50 billion. Yeah, so what makes up of the public and private contracts within this chart? For the public contracts itself, we have the HDB BTO contracts, because the government has been supplying a lot of BTO homes because of the complaints of the rising house prices. So government has to pump in a lot of supply to curb this rise in HDB prices. And also Terminal 5, recently we had a groundbreaking for Terminal 5. So government has been releasing some T5 contracts, and there's also LTA, MRT expansion. So all this falls under the public contracts. For private contracts, why we have some semiconductor facilities, some logistics warehouses, some high-end specs logistics facilities, as well as the private healthcare hospitals. So these are some of the examples within the private contracts being awarded. Yeah, so why is this significant? Because if we see that the contracts being awarded trends higher, over the next 6 to 9 months, the construction companies will start building on the projects itself. And this is where the revenue actually comes in. So the revenue for building materials will actually benefit. And also those construction companies that actually execute these projects will also benefit. Yeah, just a bit more additional color. So if you look at 2008 itself, we can see a very sharp dip in private contracts. And we all know what happened in 2008. This is because of the financial crisis. So a lot of enterprises start to scale back on their capex investments. But however, as you can see, the public contracts actually went up. So this is the way in which Singapore government try to support the economy by bringing in more public contracts. And I would say this is sort of a safety net for Singapore itself, because even if there is a global recession, I mean, even if there is, the Singapore government contracts will still continue to be given up. For example, your HDB BTOs, it will still have to carry on. And as we all know, Terminal 5 is slated for completion in 2030. So that kind of project will still has to continue. Yeah. So this is why we think that construction is quite shielded from the geopolitical turmoil. Yeah. Okay. So this is the summary of the construction stocks that we cover. I'll just go through the points one by one. So for BRC Asia, they are a company providing steel rebar for in the construction sector. So for example, the construction walls we see here, we need the steel structure before we pour in the concrete itself. Yeah, so the steel structure is being supplied by BRC Asia. And they have a 65% market share in steel rebar within construction itself. So with the higher amount of construction activities ongoing, we do think that they will be a great beneficiary for this in this climate itself. And we do think that the increased steel volume because of these heightened construction activities will actually offset the recent drop in steel prices itself. Yeah. For Pan United itself, for those who are unsure, they are a company that provides ready-mix concrete materials for the construction industry. Yeah. So the big trucks with the turning cylinders you see on the road. So those are the ready-mix concrete. And Pan United actually holds a 40% market share in this kind of ready-mix concrete itself. Yeah, so a lot of buildings, it can range from skyscrapers to like warehouses, HDB BTOs, any kind of construction projects will need this kind of ready-mix concrete, and Pan United holds a 40% market share. Yeah, so we do think that Pan United will be a great beneficiary in this uptick in construction activities. Next, for Centurion itself, they are a provider of worker accommodations and student accommodations. Their main revenue segment is still worker accommodations in Singapore. And because of the higher rental reversions, because of the shortage of worker accommodations in Singapore, they have been experiencing higher rental reversions. And recently, there's some announcements of Centurion having the potential REIT spin-off. Yeah, so recently they filed, they provided the filing for their REIT IPO to SGX and MAS. And I personally believe that if everything goes smoothly, the REIT spin-off will happen by the end of this year itself. Yeah, so this has been a major catalyst for the stock price itself. Yeah, and if the REIT spin-off does happen, Centurion did mention that they will likely provide a dividend in specie, for example, in the form of additional stocks for shareholders. And it takes a lot of assets and liabilities off their balance sheet itself. Yeah, so that is the rationale they wanted to do this REIT spin-off. Next up, for WeHer, they have quite a lot of segments. First up is construction segment. Within the construction segment itself, they specialize in HDB BTO projects. The next segment will be worker accommodations. So similar to Centurion's business segment, they provide worker accommodations in Singapore. Next up is student accommodations. So even though it makes up a very small revenue contribution, recently they have actually sold a big portion of the student accommodation and gave out a significant chunk of special dividends, which is about 15% dividend yield. I'm sure those shareholders will have gotten this 15% dividend yield recently in May. Yeah, so for WeHer, our story for WeHer is that going forward, there is still 232 million in assets potentially for sale. So this comes from the remaining 13% stake they have in their Fund 1 assets in student accommodations. Secondly, is also their Fund 2. That will make up about 50 million in fair value. And also they are also trying to set up a fund tree. But for WeHer itself, overall for this year itself, I don't think there will be any more sales of these student accommodation assets. If there's any sale, it will likely come in the next year itself. But the main driver for this year itself is the upcoming worker accommodations because it increases the bed capacity by 65%. There's an upcoming 10,000 beds of worker accommodations in the Pioneer Lodge asset itself. And they are also trading at a 36% discount to NAV per share. Their NAV per share is 0.71, and they are currently trading about 0.45. Yeah, so compared to Centurion is currently trading at a premium to the NAV per share. Yeah, so this is why we think that WeHer is attractive also. Yeah, and recently they have also announced 439 million construction order wins. So this increases their order book by 1.5 times. And these two orders is HDB BTO projects. Yeah, so with the increase in HDB BTO projects, we do think that they will likely to score more contracts. But however, their construction segment itself doesn't contribute that much to the profits itself. Okay, next up for soil build construction itself. Last year there's a 110% increase in order book. This is because they scored a very big PSA transport contract. For soil build itself, they are a company that actually executes the construction contracts itself. Yeah, so they take in the construction tenders and then they build projects for the tenders itself. So they specialize in industrial warehouses. For example, the high floor to ceiling height warehouses. So recently, based on the data itself, there's been a spike in private industrial contracts being awarded. And we do think that this will greatly benefit soil build as well, because they have a capability in BIM modeling. So BIM, what is BIM modeling? BIM modeling is basically they will render the videos to show the tenderers what the buildings will look like from the outside and the inside. So this will give tenderers a better view of it will align the expectations better as compared to other players who will just generally give an artistic impression to the tenderers. Yeah, so this actually helped soil build score many private industrial contracts, and yeah, that's why we are very positive on soil build as well. Yeah, I think that's all for my end. I'll hand over the time back to Paul. Thanks.
Thanks, Ivan. Paul, I cover all the other sectors nobody want to cover. Okay, so let me just start with telco industry. Someone asked me why Singtel did so well. Is it a lot of people buying handphones? No, Apple looked the same 10 years ago. Only the color now got pink. So it's not because there's the popularity of handphones, but if you look at this chart, so this is the red line is the market cap of Singtel, and the blue line or dark blue line is the market cap of Bharti Airtel. So as you know, Singtel has two large parts. They own Optus and then they own Singapore. And that is 1/3 of the value of the company. 2/3 is the associates like India, Bharti Airtel, Indonesia, Thailand, and Philippines, and so on. But you notice that what has been really driving the share price of Singtel has been Bharti. You notice the market cap, their stake has risen to 40 billion. At one point in time, Bharti was worth equivalent to Singtel. So it's no coincidence that then that's where the share price started to run. So if you want Singtel to rally even more, it's really dependent on Bharti's, Airtel's share price. And of course, Singtel is selling bits of it and then giving it back as dividends to all shareholders. So the value right now is about 50 billion, their stake in Bharti Airtel. And sorry, just to go back to the title. So of course, going back to the core question of why Bharti is doing well, because they are able to raise prices. Of course, other countries difficult. So the most important criteria for outperformance, which is the obvious thing, I mean, you can increase price, right? It goes straight to the bottom line. So let me just run through all of our various views. So for Netlink, and Netlink very easy to cover. I mean, it's like the same thing. The next 5 years is still going to be the same thing. So because it's, for those who don't know, Netlink, actually all of us pay Netlink so long as you have fiber. But the yield is stable. It is really rock solid, 6%. And it's rock solid not only because of cash flow, but because they can actually borrow. Because as a business trust, the technical definition is that it's like almost cash accounting. I can pay whatever cash comes in, whatever cash comes out. So if not enough cash, just borrow. Okay, so the 6% yield is actually very stable. There's a bit of capex now, so the cash flow is a bit down because they're undergoing some capex, but you don't have to worry. I mean, the 6% is very stable, and so forth. So for Singtel, we still have accumulate. We are a bit more hesitant on Singtel because it's really dependent on Bati. They still have a target. They are going to monetize more assets. So the upside is still there. But again, you just have to keep an eye on the direction of Bati because there's two stories on Bati. Because first is the valuation. Because as Bati share price go up, then Singtel value will go up. And also, Singtel is selling Bati to give dividends. So you get that double kicker. So it's very highly dependent on Bati. So if you're Singtel shareholder today, you wake up, apart from Singtel share price, just have a look at Bati share price. The last one is StarHub. We have a neutral because there's hyper competition. We call it like the peacock competition. So during the time of the year where all the peacocks want to look for a partner, they all look very big. So before there could be consolidation. So before you merge, everybody want to look as big as possible to get as many subscribers. Hopefully StarHub don't hear this, but that's what we think is happening. We still think it's about consolidation. We did get we had some clients who complained. I don't know, said, hey, Paul, you said consolidation is coming. This is very hard. I mean, because StarHub and M1, they got a common parent, which we all know is like Temasek. So you can imagine arranged marriage, how they, ask your son, hey, can you marry? It takes time, right? So don't expect it to come anytime soon, but we think it will still happen. So don't ask us the exact timeline and all that and so forth. But we still think a consolidation is happening because both sides are actually hurt from this hyper competition. But the winner, we don't think will be StarHub. We think the winner will be Keppel because you're the one selling. So then the StarHub has to be the one to integrate, do all the painful work. You have to realign costs, realign staff, and so forth. So the preferred way, if you believe in a consolidation, will be Keppel. So if we move on to healthcare, so we call it the revenge of the insurers. That's our team. If you notice the news recently, Great Eastern mentioned that if you're going to, if you're going to, just in my mind, Mount E, another goal, please. If you're going to Mount E, you need to have a pre-authorization letter. So basically, you need Great Eastern to sign off your letter before you can go in to letter. So that has quite a detrimental effect because if I'm an AIA, if I'm running AIA, I would obviously call Mount E and say, wow, you lost insurer. So I think maybe you got to give me some discount because you got one less insurer. So there are quite significant repercussions because if you lose one insurer, the patient who wants to come in, you better have to top up better go SingSaver and top up your credit card because you have to come up with your out of pocket. And the average bill size in IHH in Singapore is about 20,000 average. So that's why we think this will definitely hurt IHH because if other insurers start to say, okay, I need a discount now, since you only left with 2 or 3 insurers, you better give me some discount. Then you get that very bad snowballing. Some of your doctors will also say, oh, I'm not getting any GE patient, or then maybe I guess you got to give me something special as a doctor. So there could be repercussions. Raffles could be a winner because Raffles does their own insurance. But you notice volumes, healthcare volumes in general are weak. You can notice the bar here, but it's all about revenue intensity. I know it's raising charge more, but anyway, it's called revenue per inpatient. So in terms of a view, we still have accumulate on Raffles Medical. The insurance negotiations could help them. China is gradually improving and they are trading at attractive valuations. So if you look at some of the private transactions that happen on hospitals, can trade as high as 50 times because there's no new private hospitals coming in Singapore. So valuations for hospitals are very high. So even if it's 20 times PE, is considered really cheap for a hospital. So these are the things supporting Raffles Medical. QMN Dental, of course, is the largest dental operator in Singapore with 10% market share. We don't think volumes are growing, but they're undergoing cost controls. And of course, the same thing, revenue intensity. And maybe they might look for some opportunity for consolidation. Thomson Medical is a neutral. So Thomson Medical, they run hospital. Of course, they own Thomson here. They also run in Malaysia. So Malaysia, they got hit. They are getting the insurance issue, but they got it earlier. They got it last year. because insurers are now pushing back because the charges are getting higher and higher. So they get that impact, but they are beginning to get the insurers back on board. And that is a slow recovery, but that's happening. And they are actually, because Thomson, is mainly deliveries. So now they're pushing more oncology and raising the revenue intensity for their hospital. Of course, the big one for them is the big Johor land that they have. So if there's any news in SEZ, if you're really positive on SEZ, so obviously, they will be the big winner because they got the hospital to be built and they got like 10 acres or 9 acres plus to sell just as empty land. Of course, all these are very good location land. So if you're optimistic on that whole Johor economic zone, then they are the ones. Okay, let me just run through for conglomerates. So conglomerates is your Sembcorp. So we think growth is coming back for the conglomerates, which is your Keppel and Sembcorp. Because if you look at this chart, okay, this is like an aircon chart because it's electricity usage. So you notice 2019 to 2024 is about maybe 1%. The blue line and red line is not my forecast. These are the EMA's numbers. So EMA is actually guiding very strong growth. It's not because it's getting hot, but maybe also, but it's because there's going to be, there's going to be more data centers in Singapore. Every one of us is going to end up having to use some EV or electric vehicle or one or another. So that's why there's going to be a big ramp. And I guess in a way you can also kind of sense it when the EMA or the authorities say we need to import. Because if you have enough power, why do you need to import it? And import all the way from Australia. I mean, hopefully it doesn't. I mean, like it's a bit far, right? And it's solar, so you better pray there's a lot of sun. And if it's night time, probably you got to switch off everything. Okay, so our recommendations are Keppel. We still like them. I think among all the conglomerates for me or the large caps that I cover, we like Keppel the most because we think earnings is coming back. Because Keppel sold Seatrium, then the earnings came down. They had to refocus to fund management. So right now we think earnings growth is coming back, namely for 3 reasons. Because they got 1 new power plant. Number 1, then the new Keppel South building is coming up. So from no building, now you have 1 whole building to collect rent. So obviously you're going to get a lot of earnings. And the third one is their Bifrost submarine cable is completing. So they're going to get operation and maintenance. So we think earnings growth is coming back for Keppel. And of course, they got this, call it like almost like the Hong Pao draw thing, right? They're always going to do this monetization thing. So once they do monetization, they'll give a big dividend to investors. And in the background, they're also building a fund management franchise. So that's why amongst we think Keppel we are positive. Sembcorp is also accumulate. We like it, but just that the new power plant that they're getting is probably only going to come in 2027. In the meantime, they acquired Sunoco, so they're going to get some acquisition growth. And of course, they're going to get renewables. They're very big in India. I think their pipeline there, the growth there is about 40-50% growth in capacity. And you probably get the earnings only now because it takes time after you complete. ST Engineering, I think we all know everyone is just stocking up in weapons. So I think it's quite a short story here. Yeah, I'm just kidding. So you go to a lot of all the warehouses of I'm just joking here because all the warehouses full of weapons, but just kidding, okay. But just to give you a sense, right? Because if I'm a country now, you see what's happening. Who has the most weapons? Means I presume. The other thing is, of course, MRO. MRO is doing well even for SIA Engine because a lot of deliveries, a lot of planes because of COVID, a lot of planes are getting delivered late. So because all the old planes. Okay, it's not, don't worry about your safety, but a lot of old planes need to do more maintenance, which is good for ST Engineering, of course, good for SIA Engineering. Okay, this is my last one. Okay, before everyone this stock has dropped recently, I think 10+%. So before everyone let the dogs and cats out do witch hunt on me, let me just say that we still like this stock. So Geo Energy is a coal producer, and it's not just about the coal. So what they're doing, it's a bit hard to see, I apologize for that, but the yellow line that you see has been the old road that you dig coal and then you transport to the river, then it goes to the sea. But what they're going to spend is $150 million on that orange line. I really apologize if you can't really see the line on top. So with that, you are going to double or almost triple your production from 10 to 2.25 million. And not only that, you increase production, you become an infrastructure player because the capacity of that road is 50. So you can lease out that 25 to other tour operators. But in the meantime, you're not going to wait. So they're probably going to sell a stake in this toll operator and get a bit of windfall, hopefully by this year. So that's why we still like it. The stock got hit because in China, there's a bit of production capacity, too much inventory of coal in China because thermal demand is down, power consumption is down. So what they do is thermal power coal, which is used for electricity. The pictures that you see here is just artist's impression of how the road and so forth. So we still like it. And their earnings was up 100% in the first quarter because we are still assuming this year production is going to grow by about 40%. Okay, so this is our model. We didn't change, so actually you don't really have to take photo, but you can see the profile. So we didn't really change because we normally only can change our model in the end of the quarter, but it hasn't hit the quarter, so we can't really change. But this has been the one that, like I said, the Geo was hit only the last 1 month, so because of the over inventory. This is generally the performance. I'm going to run quickly, and this will be our last slide before we go to Q&A. Anyway, just to conclude, okay, anyone who just waking up, don't worry. This is the conclusion. You didn't miss much. So we still think that the trade war is still a risk in our background, although it doesn't come on the headlines. But this is a big concern for us because we don't know how to take up this risk. Anytime he can just say, like we're not going to do a trade deal with Canada, the market might react. Or what if we don't do a deal with Vietnam? So, but Singapore has the tariff. We are only 10%, so no issue for us because we already hit the max. And 10% is much better than all the countries combined because it's the lowest tier of tariff. We got the resilience, our valuation, the yield support. We don't think there's a recession. It's probably an economic shock. So prices in the US will rise. Consumers will get hit. It's almost like VAT rising by 10%, but not gradually 1. It's going to be within 1 year, 10% hit on the VAT kind of thing for imported goods. So, but we think interest rate cuts will be on the horizon and probably overweight stronger the REITs at the later part of the year. And we favor domestic sectors, especially small caps. So, like we mentioned in the previous briefing, in the second quarter, that the 5 billion that they are giving out is definitely going to come. So, so be patient, and I think this could create a bit of snowballing effect for the whole small and mid cap sector in the whole Singapore market. Okay, with that, thanks everyone for your time. I know it's quite late, and thanks everyone.
All right, thanks Paul and the team for the Singapore sharing. So before we move to the lucky draw, the final one, we will have some questions. Right, so we'll ask some questions from online and also from the physical blog. So raise your hand if you have any questions to ask them. So we have limited time, so we'll take some questions only. So for the first question from online is actually for the bank. So with the possible drop in interest rates and DBS being one of the recommendations among the banks, right? So will we be seeing a drop in any of the bank prices in the coming quarters or during announcement of the US rates?
Yeah, thanks. Yeah, it's a good question. So as I said earlier, with the interest rates are a double-edged sword. So in the first start, when it was really high, they were able to get a very high loan yields, and then they didn't raise their cost of funds, right? And that's how they got a very large NIM increment. But what we're seeing recently is that the rates have really started to drop, at least in Singapore, and we are seeing that they have to follow suit with the cost of funds. And moving forward, how will they maintain this is that they will also drop the cost of funds in line with whatever the top line is dropping, so the loan yields, right? So in tandem with rate cuts, if it does come in, they will just continue to drop the cost of funds because that's something they can control. They can't control the top, but they can control the bottom. So that's how we are assuming that they will maintain that net interest margins, at least a spread, right? That's where they will maintain. So your second part of the question is asking, based on just this information, will the bank's share price drop? Not based on just this information. Because you don't understand, when rates do drop, loans will pick up, right? That's the expectation, that loans growth will pick up. It's only single digit right now because rates haven't really been cut that severely. So we believe that loans growth will sort of counter effect that contraction in the NIM that we are seeing. So it's really, you take from one side, but you also take the other side, right? And vice versa. So that's why for the banks, I think they will hold quite stable. The really main issue, which I mentioned earlier quite a bit, was the provisioning. But the banks are actually quite well provisioned and they have huge allowance coverage. Right? They're just putting on more and more. Yeah, so we could see possibly in the future, if they want to, inorganically boost their earnings, they will just write back these general provisions. They have done it once or twice, but not drastically. So that's where we could see, a further increase in earnings. But as of now, in the near term, right, for the next year at least, I don't see it coming. Yeah, but if you look medium term, we could see them writing back, continuing taking back a lot of these provisions, and then we'll see it up in earnings. But for now, no.
Right. So any questions from the floor? Anyone? Yes. Exhibition.
I think there was a good coverage of many stocks, but you didn't touch much on technology, in electronics and technology. We did hear earlier a little bit about Franklin and all that, but on balance, what are your preferences now, given there's a talk of a semiconductor recovery and so on? Yeah.
Thanks for the question. Yeah, regarding technology itself, for Singapore stocks itself, we do favor Franklin because Franklin's largest customer is ASML and Applied Material, and currently their revenue has been in an uptrend, and they have provided very positive guidance. Yeah, so this will naturally flow downstream. And however, if you do want to invest directly in tech itself, my personal recommendation would be to directly invest in US stocks. Yeah, because
But if not, no questions. Maybe anyone want to give a conclusion for any Singapore market? Any conclusive statement for your sector that you're covering? Then we can end the Q&A.
actually, no, just good luck on your talking goal. I don't think anybody wants to hear on the conclusion.
Right. So it's been, I think it's been quite a long day. So we will then move to the one that I think some of you are, all of you are waiting for.
Thanks,
for the lucky draw. Can I thank